Evening, I am the Stock Signaler. I am a computer programmer that develops models and algorithms to conduct technical backtesting of the stock market in order to attempt future analytic forecasts. Tonight's video is a new subject regarding application of wave analysis. As many are aware, I applied modified wave theory to the stock market, particularly the S&P 500 to forecast future movement. I assess we have been in a correctional pattern that began with the market's recent top in January of 2022. I have applied all sorts of models during the market's recent bull run, however was not looking at models that would achieve new market highs, as this rarely occurs. Once we neared and after the new market high did happen, it was time to review those rare models for possible insights on this market. If we were not approaching a debt bubble and goods and services were priced affordably, I most likely would not expect the market to drop quickly and soon. But since I feel those things are true, the market must correct quickly and significantly to restore prices to affordable levels, which will ultimately quell inflation. Here is the Tradingview chart of our current behavior. Wave B has moved beyond 100% of all of Wave A's movement. And for an example, this means Wave A began over here on the left. And as I draw this line, once Wave B broke that, it is considered that Wave B moved more than 100% of Wave A. And in fact, where we are right now, it has moved, I think we're above 127%. So right now we have gone more than 127% of Wave A's movement. So what does this mean? Here is a comparison of multiple wave models over the years laid on top of each other. Now, while this looks like a giant mess, some of the things that are obvious here is you move down in the beginning and it moves up. What we're looking at is the same as our current modeling, where Wave A went down and then Wave B moved up. So that's the same thing that we're looking at here. I'm going to go through and break this out. This is just to look pretty ugly. Here's all the years of the models I'm going to look at. So our first event, here it is. So the pink model, as I go through, will be our current position. A comes down, B goes up. The first event was from 2023. This is actually an inverted model. The ABC in this instance actually went A moved up, B moved down, and C moved up. But I've inverted it and I've overlaid it on top of our current situation so you can kind of see where things occurred. Now in this model, A occurred earlier than our current Wave A. I've stretched it out so you can see where B ended up. It looks pretty similar to what we're looking at. In 2023, this is what the move was. Now remember again, this is inverted. Instead, the A would be up high, the B would be lower, and the C would be high again. Our current scenario, I've maintained this on all these slides. It's going to be in the top right, and it's just if you had to look at the slide as a one-off, you can remember where we are with our current model, and our current forecast is the 2022 high, and then it drops down to October of 2022, and then Wave B. Right now, we're still actually moving up in Wave B. We haven't technically topped. It is possible that we saw the top, but that's not confirmed yet, since it was Friday, basically the high on Friday. Our current top for all the math to be applied is 51.8926, and so far Wave B is 351 trading days. Now in the bottom left of this chart is all the movement of the 2023 scenario. So in this case, Wave A moved almost 75 points over 58 trading bars. I believe the chart we're looking at is a 6-minute chart. Wave B then moved up almost 90 points, and then Wave C moved 150 points from there, over 150 trading bars. Now I keep these ratios broken out just to help out and try to figure out where we're going to go in the future. In this instance, Wave A, as far as duration goes, those 58 trading bars was only 30% of Wave B's 193 trading bars. Wave B moved almost 120% of Wave A's movement. That's where they moved 90 points over the 75 points. In this instance, Wave A was also shorter than Wave C, and Wave C was nearly it's nearly twice the length of Wave A. So Wave C moved 150 points over the 75 points. Now, if we apply what occurred during this instance to our current scenario's data, Wave B could last 647 trading days. So far, we're only at 351 trading days. A full application of this model would say we have a long way to go. The market would gain 1591 points and place the market top at 5,082.72. Well, we've already passed that level. So not only have we already passed the projected market top and only gone half of the trading days, this model may not be completely close to what we're looking at, but it's good to consider all the models, and then we can move forward from there. Also, if this model plays out, wave C would then possibly lose up to 2,700 points over 501 trading days. All right, so the next event was 2018. Again, here's the overlay. The overlay of the 2018 is in gray. It was actually, wave A was very short. It's well over here on the left is the bottom of wave A. And then it kind of did a jump up quickly, came back down, and then it finally went off and did its wave B thing. Again, here's all the data for it. Current scenario in the top right. That maintains what we're currently looking at today. The numbers in the left, so the things we're going to look at now is just when we apply the numbers of this event to the current scenario. Wave B could be 536 trading days, and the market top could be at 5101. Once again, the trading days are much farther than we are currently, and we've already surpassed that market top. So 2018 model, once again, it may not come to any of those numbers since we've bypassed one and we're well under the other, but it's also good to have here. The next event is from 2014. It's more of the maroon modeling. Now, wave A kind of went the same distance. It was a little short of where our current wave A is. As far as how the B moved up, it really moved up big, came back down toward the end, and then did its final push. So far, we have not seen that with our current situation. And here is the data for 2014 model. If we apply this data to our current situation, once again, we're looking at a high number of trading days, 548. The market top would be around 52.67, 56. Now that number is still technically in play. I don't think it's going to take us 200 trading days to get to that point, but it's a good number to keep in mind. So this 2014 model could have some assistance in figuring out where we're moving. After that, the wave C loss. Now in this case, wave C went pretty far. It dropped a lot in a short amount of time. I don't know if we're going to lose 3,200 points in just over a year and a half of trading, but those are just some numbers that we'll worry about once wave B is finally topped. 2011 is the next event. Now for this one, it was a very short duration event. I don't remember what modeling I'm using here. I think I'm down to like a 30-minute scale, and the bars were just very quick. It happened over the course of like 2 weeks. But trying to apply it here, we'll look more at the numbers because that's where it plays. Over here on the right is when we apply it to the current scenario. Look at 715 trading days and a top at 52.77. Once again, the trading days are very, very far away, while that market top is not. So we may be able to take some numbers from here, but not likely. After that, wave C to lose 1488 and 130 trading days. That could be important, something that we're probably going to look at moving forward. Next event is from 2005. This one actually we're going to maintain quite a bit as we move forward. A moved roughly the same as our current A, and then the 5 waves up, that are probably the 8 waves that we've done so far in our current situation, are very similar to what occurred here, and that's interesting here toward the end where we had our what I called wave B down. This one appears to move together. So when we look at these numbers and we apply them to the current scenario, wave B is at 459 trading days. Still, it's a little bit of ways away. The market top is at 51.17, which we once again have surpassed. However, we're going to keep this model in mind moving forward. The next event was 2000. Now the 2000 event I've been considering for quite some time. This is where the A began in March of 2000, and then we dropped down to October of 02, and then I think we topped out in the summer of 07. So it was a over a long period of time this one happened. And as you can see on the overlay, it plays out pretty decently. However, this event barely, when wave B went up, it barely retraced all of wave A. I think it moved right here, 103% of wave A. We've already bypassed that. Hence, the 384 trading days, that is in the near term possible. However, the market top we've already well surpassed at 48.57. Moving on to our next event in 1990. Once again, wave A finished earlier. Wave B was quite active. It did have some similar movement to what we've seen in our wave B. And when we apply those numbers to the current scenario, we have our trading days at 1,180. That's going to take a couple of years for us to attain, so I don't think that number is going to be valid. Once again, the market top is actually at 51.17. So that's interesting because we had this same number very recently in one of those other models. And then wave C is tracking to lose 2,400 points in 636 days. Next event was from 1979. In this case, A was on the quicker end, and B, as it moved up, it kind of had similar movement to what we're seeing in our wave B with the significant drop there in the middle, and then it continued up. This is another model we'll continue to watch. The trading days were at 1,401 for wave B projection. Once again, that's pretty far away. However, the market top is at 56.35 in this case, so were it to play out, we would have many more days of bull movement. I don't think this is likely. In this case, wave B moved 161% of wave A's movement. In the model studied, this is the largest move of a wave B, and therefore I think it is the least likely. The next event is from 1968. Through the studies, this event appears to be the most closely related to our current situation. On the overlay, A ended roughly the same point in time, and wave B also had a move up and then a significant correction to itself before it continued much higher. In this instance, we're looking at 352 trading days and a gain of 1729 points. Well, currently, as of Friday's high, we are at 351 trading days. Therefore, this model says we could top by Monday. For us to reach a new high on Monday, that would be a very strong day of trading on Monday. So we'll have to see how that works out. As far as the market top 52.21, that is also within range, considering we are back in the 5100 zone right now. After this occurs, wave C could lose 2,000 points, thereabouts, over 231 trading days. Again, these are completely possible targets, and we'll get more into this in a second. The last model is from 1965. In this instance, A was early in the timeline. B also had that pullback where it went up high, came back, and then it continued higher toward the end. And the 1965 data would have our current wave B trade 950 days with a top at 53.57. 950 days, once again, it is pretty far in the future. 53.57 is a possible top, probably in the next couple weeks if that were to occur. Now, here's all the ABC modeling laid on top of each other just so you can see where they fall again. We're not going to spend too much time on this, but you can just use it as a visual aid if you would like. Now, the wave B points of interest that matter here. So our possible wave B durations that are still in play are the leftmost column, and I've called out that March 11th is day 352. That would be tomorrow at the time of this video. Another day in the future could be 384, and then our numbers kind of increase from there. Pretty much anything above 500 falls into the unlikely zone, but we'll see where things end up. As far as possible wave B tops, it was interesting that we had two at 51. I rounded up. It was 51.17, like 87 and 90 something. Our next possible target we have not hit is 52.21, followed by 52.67 and 52.77. Now, our historical wave B extensions from least to largest, so 2000, like I said, we barely retraced all of wave A's movement. And then our 2023 model, there seems to be a nice pocket here around 120%. And then there's also another pocket in the 130 to 140 range. We are currently above 127%, so the next possible target would be at 130%, and that would be the top at 52.2138. Now, once this occurs, even though we've so far topped at 51.89, we're going to consider the data that we saw earlier, and then we'll try to calculate some bottoms if the top were to reach 5,200. If we do remain at 51.89, then simply subtract 11 points from the values on the right column. So the left column has our possible wave C durations. My likely zone is probably above 231 trading days and likely below 344. However, here are all the numbers for what wave C could do depending when wave B ends. Our wave C losses are in the middle. This is how much the market would lose, and then those market bottoms is the far right column. And once again, looking at a range between probably 2,700 and 3,700 is the most likely. And we'll kind of get into more of that later. Now we're going to go back to our Tradingview chart and kind of apply some of these values as I've marked them out already. All right, so the first things we're going to look at, like I mentioned, we already are at, we're above 127%. Our next value is at 130. When we look into the future at what we could be anticipating, some of our highs that stick out. As far as trading days for wave C, looking at 231 trading days puts us February 2025. 288 days is May 1st of 2025, and 314 days is June 9th of 2025. My speculation at this point is we will finish sometime in those areas. And to make this cleaner, I'm going to try to look at it on a 3-day chart. Just kind of spreads things out better. All right, as far as our lower values, we had values at 35.75, let's see, 35.73, 32.21, and 27.49. So those are the ones that we're focusing on here. Our yellow line is at 35.73. Our next one is at 32.21. And the lower level is down in the 27 range. My laying out the models, sticking with the 1968 model, which I like the most, is our model in green here. So roughly, if we followed the same movement, which we probably won't, but in some capacity, we could see a steep drop early, move up for wave 2, down hard again for wave 3, 4, and 5, and we would settle our bottom around 32.20 by February 7th. The next model is in yellow. This was, I believe, the 2018 model, where we'll come down early and then nearly retrace all of our first drop before really coming down hard. And this looks like it would be most of late this year. We'd get a slight reprieve, and then we'd finally bottom May of 2025. And what is interesting about this low, or this model, is it actually goes well below the other models. This has a decent date range and time to make the drop it needs to happen. But typically these drops are short and fast, so that's why the green 1968 model looks the best. And our last model is the 2005 model. It is the magenta solid model. It actually has the least drop over the longest amount of time. To me, that is not as likely. However, it's just, I put it on here to see how they fall down. Basically, we would drop pretty hard to May 20th of this year. Maybe we rise back to about 4,900 by 2 August. And then we come down to 4,000 by January, a quick bump up somewhere, and then we finally settle at 35 in the 3,500 zone. So based on the models, this is my predicted forecast and layout if we are following any of these corrective patterns. Now, if we continue to move well above 52, 53, 5,400, this whole thing is probably not likely. But considering the debt bubble that I mentioned earlier and the prices and goods not aligning yet for affordability and inflation yet to actually drop month over month, we're probably on track to do something along these lines. But thank you for listening.